So this is something that you have to be very careful about. So now I want to talk about the top 10 tax deductions and credits for parents with children and dependents. Do not go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you're to ask me, and if you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to talk to you quickly about the top 10 tax deductions and credits for folks with children and dependents. Now, your kids can be beneficial at tax time. Not just at tax time, but tax time you can feel the financial benefit a lot more. That doesn't mean they will sort your tax receipts or refill your coffee, right? But those charming children may help you qualify for some valuable tax benefits. The IRS defines a dependent as a qualifying child or qualifying relative. Remember those two words, all right? In most cases, a child can be claimed as a dependent in the year they were born or adopted. And so basically, the easiest and most accurate way to find out who you can claim as a dependent on your tax return and what tax credits and deductions you qualify for is to start a tax return. You need to file a return to actually benefit from those credits. Now, let's talk about number one, the child tax credit. What is it? You may be able to get a child tax credit for each of your qualifying children under age 17. So this partially refundable credit is intended to offset the cost of raising children. Thank you, America. So the maximum amount you can get for each child is $2,000 for tax year 2020. Now, if you don't benefit from the full amount of the child tax credit because the credit is greater than the amount of income taxes you owe for the year, you may be eligible for the refundable additional child tax credit, the ACTC. And if you have a qualifying child at the age of 16 or younger as of December 31st, 2020, you may be able to claim the child tax credit. All right. Now, the one thing I want to say here is that here are some important facts about the child tax credit. So this is actually, it can be worth as much as $2,000 per child for tax years 2018 to 2025. And basically, you can, for 2020, the child tax credit begins to phase out. In other words, decrease in value at an AGI, adjusted gross income of $200,000 for single and then $400,000 for married filing jointly. All right. So to qualify for the child tax credit, you must have a child or dependent who meets all of the following requirements. So the age, so we have age 16 or younger, citizenship. He or she must be a United States citizen, a United States national, or a resident alien. Dependent, so the child must be claimed as a dependent on your tax return. The relationship, so the child must be related to you in some of the following ways. You can be a son, daughter, stepson, stepdaughter, brother, sister, stepbrother, stepsister, grandchild, niece, or nephew. All right, and this actually includes any legally adopted child, any child lawfully placed with you in preparation for adoption, and any foster child lawfully placed in your care. Residency, the child must have lived with you for more than half of the year, stayed with you for at least 183 nights. Okay, so temporary absences for special circumstances are generally acceptable, and special rules may apply if you are divorced or for other circumstances. And the support criterion is very important. So the child must not have provided more than half of his or her own financial support for the year. I want to quickly talk about the additional child tax credit, the ACTC, the additional child tax credit. All right. Now, the additional child tax credit, and we have covered this at length in another show. And basically, I just want to say that this is a refundable credit that you may receive if your child tax credit is greater than the total amount of income taxes you owe, as long as you had an earned income of at least $2,500. So for 2020 returns, the ACTC, the additional child tax credit, is worth $1,400. Okay. And one thing that I want to say here is that if you qualify and claim the additional child tax credit on a tax return, you might get a refund even if you do not owe any tax. But you need to actually file a form called Schedule 8812. Okay, and this is the form that allows you to actually claim that tax. And basically, the child tax credit is partially refundable. I think I've said it before. What does that mean, partially refundable? It simply means that some of the credit is non-refundable while some is refundable. And the amounts will be reported in two separate sections of your return. Okay, a non-refundable credit, as the name implies, means that the credit cannot be used to increase your tax refund or to create a tax refund when you don't already have one. All right. So refundable tax credit, on the other hand, are treated as payments of tax you made during the year. So basically what happens is that when the total of this credits is, let's say, greater than the tax you owe, guess what? The IRS sends you a tax refund for the difference. And one thing I also need to say on this section is that only one taxpayer or a married couple filing jointly may claim any one child for the purposes of the child tax credit and the additional child tax credit. So you cannot have double dipping here. The IRS does not allow that. So if a child, for example, is claimed as a dependent on more than one tax return, the IRS will determine who gets the claim according to a set of tiebreaker rules. Okay, and basically this is what happens when you have dependent claimant disputes. And one thing I also want to say that the IRS goes through, they actually evaluate the merits of each claim based on the social security number, but based also on a set of criteria, including how long the child has lived with the parents claiming the child on their return. Number two. So number one was a child tax credit. Number two, you have credit for other dependents. So dependents who do not qualify for the child tax credit may still qualify you for the credit for other dependents. And this is a non-refundable, I repeat, non-refundable tax credit of up to $500 per qualifying person. And the qualifying dependent must be a U.S. citizen, U.S. national, or U.S. resident alien. Number three, we have child and dependent care tax credit. So you may be able to claim the non-refundable, again, this one again is non-refundable, the non-refundable child and dependent care credit if you pay someone to care for your child or children under age 13 so that you can work or look for work. And this credit can be worth up to 35% of some or all of the expenses you pay to the care provider based on your yearly income and the number of children. And the maximum credit for 2020 is $3,000. So if you paid someone while you were looking for work, that's fantastic. All right, this is just great, and this is really, really cool. And based on our research, you can actually save a lot of money. Let's say you have one kid, for example, and last year you spent $2,500 on child care, and your taxable income was $50,000. So based on your income, you would be eligible to claim 20% of those costs, leaving you with a pretty nice $500 tax credit. And that's more than chump change, right? That's fantastic. And qualifying child care expenses include more than just daycare. Don't forget about nanny services, after school care, and summer day camps. Of course, last year was a little special with the COVID-19. A lot of summer camps were closed, but you get the gist. You can actually figure out what kind of expenses you had incurred while looking to care for your child. Just make sure you have the name, address, and taxpayer identification number for each care provider you've used. Number four, we have the Earned Income Tax Credit, the EITC. And this is a fully refundable tax credit for low-income people who work and have earned income from wages, self-employment, or farming. And the EITC reduces the amount of tax you owe and may also give you a refund. Number five, adoption tax credit. So let's say if you have adopted a child this year, congratulations on your new addition. Fantastic. Not only did your family grow, there's also a good chance you'll be eligible for the adoption credit. All right. And this is basically a credit that covers up to $14,300 of your expenses per adopted child. Okay. So according to the IRS, qualified adoption expenses include adoption fees, court costs and attorney fees, traveling expenses, any other costs directly related to your adoption. So the cool thing that happens here is that if the credit is larger than your tax bill, you may not get the whole amount back this year, but you can use the remainder on your future tax bills for up to 5 years. Also, if your employer provides adoption assistance, you can exclude that amount from your income up to the $14,300 amount. Here's the thing though, and this is something you need to pay attention to. You cannot claim, and I want to repeat it, you cannot claim the credit and the exclusion for the same expenses. You can, however, combine both the exclusion and the credit to get the entire $14,300. Okay, and here is how this works in reality. Let's say you spend $10,000 on adoption expenses to bring home your beautiful new bundle of joy, right? Your employer has a really great adoption assistance program, and it kicks in like $4,000. So what you have to do here is you have to exclude the $4,000 from your income. Now you subtract that $4,000 from the overall $10,000 that you would have used on the tax credit anyway, leaving you a maximum $6,000 adoption credit. So that's $10,000 minus $4,000, that's $6,000, right? And don't forget to add the child tax credit and any child care expenses now that you are a parent, right? Remember, there is an income limit for the adoption credits or the exclusion. So if you make less than $214,000, $214,520, you are eligible for the full amount. You qualify for a reduced amount between $214,520 and $254,520, and it's eliminated completely at $254,520 and up. So at above that amount, $254,520, the reduced amount is completely eliminated. So there's no more credit. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We are having a walkthrough, and I'm giving you the top 10 tax deductions and credits for parents with children and dependents. And number 6, we have the American Opportunity Credit. That's one of my favorite credits. Fantastic. You can claim the American Opportunity Credits if your child is in his or her first 4 years of post-secondary school. And the maximum amount you can claim is $2,500 per eligible student per year, and the credit is 40% refundable. And this credit applies to any qualified education expenses. I'm talking about tuition, school fees, required textbooks, okay? And the credit actually covers 100% of education expenses up to $2,000 and 25% of the next $2,000 after that. So for all of you math or science majors out there, or arts major out there, that means you could get a maximum credit of $2,500. And there is an income limit of $160,000 for married couples, and above that it starts to phase out. So once you make more than $180,000, you cannot claim the credit anymore. Number 7, we have the lifetime learning credit. So if your dependent doesn't qualify for the American Opportunity Credit because he or she already completed 4 years of post-secondary school, you may be able to claim the lifetime learning credit. So the amount of the credit is 20% of the first $10,000 of combined post-secondary tuition and fees you paid for your dependent child, and it is non-refundable, okay? And the per year, not per child, it's per year. The per year total should be no more than $2,000. And even though you cannot claim both education tax credit for one student, you can claim one of the credits for one student and the other credit for another student. So there is flexibility around that deduction process. Number 8, we have the student loan interest tax deduction. So you may be able to claim the student loan interest deduction for interest paid on a qualified student loan, even if you choose to claim a student tax credit. And if you decide to claim the deduction, you could reduce your taxable income by up to $2,500 of the student loan interest you have paid for your dependent child. This is fantastic, right? Think about it. And even better, you don't need to itemize your deductions to claim this deduction. And this is what fiscal experts called above the line deductions. So it has no, whether you itemize or not, doesn't really matter. You can still deduct it. So number 9, we have standard deduction and head of household. This is a pretty cool one. So the single or head of household filing status on your tax return has an indirect impact on the standardized deduction amount you'll be eligible for, right? Because the government has those categories, and the amounts differ. The amounts vary based on the category you choose. So you don't have to worry about the amount, as it will be applied based on your filing status. And as long as you prepare your taxes through a tax software, it will be done automatically. So if you are a single parent, in most cases, you can file as head of household. Not only could that lower your tax rate, it also allows you to take a higher standard deduction. Let me give you an example. Let's say you file as head of household in 2020. Your standard deduction will be $18,650 compared to just $12,400 for a single person. If you really think about it, that's kind of cool, right? That's a whopping $6,250 difference. Wow. Fantastic. Number 10, we have dependent earned income. So keep in mind that even though, let's say, you might claim a dependent on your tax return, you don't claim any income they earned from working. So in the case where your dependent has income, he or she may be required to file a tax return. Okay, so if that were to happen, you may not be able to claim the person as a dependent based on various factors: the total income earned, the filing status, the age, and the amount of support you have provided to your dependent during the tax year. However, you might be able to claim the person as an IRS qualifying relative based on the factors above. Now, the factors that I just mentioned. The important thing to remember here is that there are some limits and qualifications. There are several ways that you can work around this situation, but it really depends on every person. And I would strongly advise you, and for not just for this depending earned income issue, but also for other credits that I've been talking to you about, to really contact a tax specialist. It could be he or she could be a CPA, or an EA, an enrolled agent, or a tax attorney, to really sort of see the right solutions for your particular case. But yes, based on our analysis and based on our research, it is possible to work around the restrictions that are currently in place around the dependent earned income category or credit. I want to give you some credits. I want to give you bonuses. Actually, we have 2 more we have identified in our research, 3 more elements that we want to share with you. And we have the dependent investment income. This is a great tax deduction and credits that you might want to apply. They might apply to your situation. So according to the IRS, you may be able to qualify to include your dependent's investment income on your tax return. So your dependent will not be required to file a return if you choose to do this. So you can do this if you meet the following conditions. So the dependent was under 19 years old or under 24 years if he or she was a full-time student at the end of the tax year. But the dependent's total gross income was less than $10,000. The dependent is only from the income is only from dividends and interest, and so you got to include capital, and this includes capital gains distributions and Alaska permanent fund dividends. The dependent did not file a joint return for the tax year. Your child is required to file a return unless you qualify to include the child's income on your return. No federal income tax was withheld from your dependent's income under the backup withholding rules, and no estimated tax payments was made for the year, and no overpayment from the previous year or from any other amended return was applied to the current tax year under your dependent's name and social security number. And last but not the least, you are the parents whose tax return must be used when applying the special tax rule for children. So basically, to apply for the election to include your child's investment income on your tax return, when you prepare your return through your software or manually, you can complete Form 8814. This is called the parent's election to report child's interest and dividends. And you want to actually file this along with your return. And please note though, if you choose to include your child's investment income on your tax return, your tax rate may increase in comparison to filing a separate return for your child, and thus you cannot claim certain deductions, such as itemized deductions. This is very important. Okay. However, under certain circumstances, a child's investment income may be taxed at your tax rate as a parent if all of the following factors apply. Your child's investment income was more than $1,900 for the entire tax year. Your child is required to file a tax return. Your child was either under 18 years of age at the end of the year, under 18 years of age at the end of the year, and did not have earned income that was more than half of his or her support, or a full-time student over the age of 18 and under 24 years of age at the end of the tax year and did not have earned income that was more than half of his or her support. And you also have at least one of the child's parents was alive at the end of the year, and the child did not file a joint return for the tax year. So if all of the factors that I just listed, the 5, apply to the child with investment income, and you don't or cannot choose to include the income on your return, Form 8615, tax for certain children who have investment income of more than $1,900, must be completed and attached to your child's tax return. Another bonus tax deduction and or credit that we have unearthed while doing our research is the health insurance deduction for children of self-employed individuals. So if you were, let's say you were self-employed, for example, you are a sole proprietor or an independent contractor, and you paid for health insurance, you may be able to deduct any premiums you paid for coverage for any child of yours who was under age 27 at the end of the year, even if the child was not your dependent. And to qualify for this deduction, you got to really, one of the following statements must apply to you. And please pay attention here. So we have 4 statements, 4 scenarios. So you were self-employed and had a net profit for the tax year reported on Schedule C, profit and loss from business, Schedule C easy, net profit from business, or Schedule F, profit and loss from farming. Scenario 1. Scenario 2. You were a partner with net earnings from self-employment for the tax year reported on Schedule K1, partner shares of income, deductions, credits, etc. This schedule is for Form 1065 U.S. return of partnership income. Scenario number 3, you used one of the optional methods to figure out your net earnings from self-employment on Schedule SE, self-employment tax. And scenario number 4, you received wages from an S corporation in which you were a more than 2% shareholder. So health insurance premiums paid or reimbursed by the S corporation are shown as wages on Form W-2 wage and tax statement. So the insurance plan basically must be established under your business, all right? And alternatively, it could be considered for establishment as discussed in the following statement. So let's say if you are a self-employed individual filing a Schedule C, CEZ, or F, a policy can be either in the name of the business or in your name. For partners, a policy can be either in the partnership's name or the partner's name. You can either pay the premiums yourself, or your partnership can pay them and report the amounts on Schedule K1, that's for Forms 1065, and as guaranteed payments to be included in your total gross income. All right. So, but however, if the policy is in your name and you pay the premiums yourself, the partnerships must reimburse you and report the premium amount on Schedule K1 as guaranteed payments to be included in your total gross income. Otherwise, what's going to happen is that the insurance plan will not be considered to be established under your business. Very important. Okay. So for more than 2% shareholders, a policy can be either in the S corporation's name or in the shareholder's name. You can either pay the premiums yourself or your S corporation can pay them and report the amounts on a Form W-2 as wages to be included in your total income. However, if the policy is in your name and you pay the premiums yourself, guess what? The S corporation must reimburse you and report the amount on a Form W-2 as wages to be included in your total income. So this is things you have to really think about. The third gem, the third wonderful gem, fiscal gem we have found for you is something called the tax advantage college savings, right? So while we're talking about college, we're talking about education, we're talking about students who are under the age of 24 and over 18, you got to know that there are certain types of college savings programs that are tax exempt. That's right. You can basically, literally, save for your kids' college tax-free with something called the ESA. So this is the Education Savings Account. You can even use a 529 plan for that. So before you start saving up that college fund, though, we actually recommend you do three things. Very important. So as we're talking about tax season here, you also have to think about long term in terms of if you get a refund from the government, then you have to think about maybe putting that cash somewhere, either to pay off debts or to sort of start an emergency fund, right? Or a rainy day cash account. So make sure you're out of debt. You're right. I'm talking about debts that is not good, quote unquote, bad debt. Everything about credit card, whatever. You want to have debt that is good, debt that is attached to an asset, a capital asset. So a mortgage is great. All right. And have an emergency fund of 3 to 6 months worth of expenses. This is basically what you hear all experts say. We here at the Sweetie Kiwi Show, we are a little more conservative, and we would say go 9 to 12 months worth of expenses if you can. And the third thing I want you to think about when it comes to tax advantage college savings is to contribute 15% of your income towards retirement savings. You want to get into that I would say continuum, if you will, into that philosophy, life philosophy, where you are trying to save money automatically. So trying to go for a 15 to 20% of your income when it comes to a savings threshold, that's a good way to start. That's the good way to really start, not only toward retirement, your own retirement, but also for your children's future education prospect. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, I want you to stay marvelous. But before I do that, I want to quickly recap today's conversation. The top 10 tax credits and deductions for parents with children and dependents. Number 1, the child tax credit. Number 2, credits for other dependents. Number 3, child and dependent care tax credit. Number 4, earned income tax credit. Number 5, adoption tax credit. Number 6, American Opportunity credits. Number 7, lifetime learning credit. Number 8, student loan interest tax deduction. Number 9, standard deduction and head of household. Number 10, dependent earned income. Number 11, dependent investment income. Number 12, health insurance deduction for children of self-employed individuals. And number 13, tax advantage college savings. Thank you so much. I really appreciate it. Until next time, remember, stay marvelous.